Hello and welcome to my channel. Today, we're going to dive into the world of the Federal Reserve System, the central banking system of the United States. Imagine a world where the government has complete control over the money in your bank account. Sounds ominous, right? Well, that's exactly what the Federal Reserve System allows for. But don't worry, it's not as scary as it sounds. In fact, it's an integral part of our economy and plays a crucial role in maintaining financial stability. Let's start by understanding the history and creation of the Federal Reserve System. The Federal Reserve System, also known as the Fed, was created in 1913 with the passing of the Federal Reserve Act. This act established the Fed as an independent government agency with the primary goal of promoting a stable and healthy economy. Now let's look at the structure of the Federal Reserve System. The Fed is made up of 12 regional banks spread out across the country. Each bank serves a specific geographic region and is responsible for implementing monetary policy within that region. Now let's understand the role of the Federal Reserve System as the lender of last resort. One of the most important roles of the Fed is as the lender of last resort for commercial banks. This means that in times of financial crisis, the Fed can step in and provide banks with the necessary funds to keep the economy from collapsing. Now let's take a deeper dive into the role of the Federal Reserve System in setting monetary policy. The Fed uses a measure called the Consumer Price Index, CPI, to track inflation. The Fed's target for inflation is usually around 2%. And they use this as a guide when making decisions on monetary policy. Now let's explore the tools that the Fed uses to control the money supply. The Fed has several tools at its disposal for controlling the money supply, including open market operations, setting reserve requirements, and using discount lending. Now let's understand the role of the Federal Open Market Committee, FOMC, in making decisions on monetary policy. The FOMC is the group within the Fed that is responsible for making decisions on monetary policy. The FOMC is made up of 12 members, the 7 members of the Board of Governors, and 5 of the 12 regional bank presidents. The FOMC meets 8 times a year to discuss the current state of the economy and make decisions on monetary policy. The Fed also plays a key role in regulating and supervising banks and other financial institutions to ensure stability of the financial system.